The truth is that you can invest in dozens of different companies and them look very, very different, but they have a similar thread, and that's that people are scared. People are worried. There are bad headlines. Value investing at its heart is just using bad headlines to make great investments. That's what we're looking to do. We're looking to exploit that human psychology. On the other side, we're also looking to exploit the greed by selling out of investments as valuations become very frothy. That's what gives us confidence that we can continue to do this irrespective of what market comes over the next 5 years, what macro trends pervade, what kind of political environment we find ourselves in. If humans are humans and human psychology remains the same, we can exploit that for our investors. So in our global fund, we've done that with a number of banks and commodities, and the one most recently that comes to mind is Anglo-American. That's a stock which in 2015, when we were building that position, the shares were falling and falling. And I remember thinking we'd got a great price for that investment, and turning around 3 months later and the shares were 50% lower. That's a very low moment. And we were forced to really look very hard and make sure we understood what we were doing. Did we understand the balance sheet of this business? Was it going to go bust or disappear? We didn't think so, and so we continued to buy more shares. We weren't sure how long it would take to turn around. Typically, we're buying shares for 5 years. This is a long-term strategy. As it turned out, things turned around much more quickly, and those shares rallied between 400 and 450% over the next 17 months, which is clearly an extraordinary return. We continue to cut that back. Anglo-American is a kind of marquee example of the kind of returns you can make, and not every investment is like that, but many are. There's a lesson to be learned from every investment, whether it does well or whether it does badly. This is a difficult game, investment, because you're frequently, you can learn the wrong lesson. If a share goes down and goes to zero, should you do that again? Well, obviously not, except maybe you should, because you're playing the probabilities. On average, if you did that same thing 100 times, would you make money for client 70? Because that's what you're focusing on a portfolio. When I first started as a recovery investor, the previous manager of the fund I was taking on said, I'm going to give you one piece of advice, the piece of advice that I got given when I took on this fund. And that's if you don't have one company going bust on you every year in this product, you're not taking enough risk. I took that advice seriously because he was talking about a product which had outperformed by 3% net of fees per annum for nearly 35 years. That's an extraordinary track record. That's a track record that we're very pleased to be able to say in the UK we've replicated over time, and it's the kind of returns you should look to expect from a strategy with higher risk, and that is a global recovery strategy.